James, can you just confirm that? There you are, just seeing you pop up. Just checking. It would be a really short webinar if you weren't here. Hi, everybody. So if you can't remember my name, thank you for joining the South Yorkshire. I'm Tim Newson. I'm a program manager in the People Experience team at the NHS South Yorkshire Integrated Care Board. As you've just seen, this webinar is going to be recorded and it'll be shared in the Financial Wellbeing webpage. At the bottom, you'll see all of the recordings. And if you want to book any more webinars, you can go into our up and coming health and wellbeing webinars and courses. We do have the repeat of this webinar going on in July, so we'll be repeating this. The first one is on the 2nd of July, so you can hit that link and book up for that as well. Just be aware we do advertise all of our webinars from health and wellbeing, AD&I, etc., on Twitter and Instagram, and we'll put the hashtags in the chat right now. So today's webinar, it's myself and James Justins, and what we're going to be doing is answering the questions that we've taken from the chat and emails that you've sent to us, and from the chat from the 9th of this month where James delivered a webinar, and what we're going to try and answer them. But firstly, before I start answering them, I'd like to say thank you all for your feedback from that webinar. It was, on the majority, really positive. A couple of people responded to say that we went through it really quickly. We will try and slow things down, but there's a lot of questions and a lot of subject matter to get through in the time that we've got. So what I will say is, if we are going too quickly and you need something repeating or explained in a different way, stick your hand up, let us know, and we can go back through it. If you're not on mute as well, can you mute? Just as a reminder, so this service that James is providing is free, and it's linked to our Mintogo Financial Wellbeing platform. That's been commissioned through the ICB and is funded up until December 2025. And that platform gives you loads of tools to improve your financial wellbeing and access to free financial advice from people like James. I will just remind you all, James isn't an expert in NHS pensions. And the people that are experts in NHS pensions are the NHS Business Services Authority. And my colleague will stick the link into that website now. So if you want detailed information about your own independent circumstances, the NHS Business Services Authorities are the people to speak to. You also have NHS employers, and they provide loads of information from articles and webinars that may be of use to you. So again, the link to the NHS employers site is just being put into the chat. And what we're doing here is we don't want to replicate what the Business Services Authority and NHS employers deliver. This is more around giving you options to help you understand your own financial situation as an overall. As I said, we are repeating these sessions in July, and if there's anything we're not able to answer today, or we need to go and do research, we'll get the information and we'll put it in the next set of webinars, and we'll come into more detail as we go through the questions. So before I start with the questions, James, is there anything you want to jump in and add to our kind of opening?
No, thanks, Tim.
No, you good? Sorry.
Yeah, I'm good.
Great. Okay.
Yeah.
Okay. So we'll get started with some of the questions. What I've tried to do is group some of the questions together, so James isn't repeating himself over and over again, moving from question to questions. So there are a lot of questions, and we'll get through as many as we can. And like I said, if we don't get through them or you haven't heard your question answered, we will be putting them on to the next set of webinars as we go. So the first set of questions is around redundancy calculations. So Julie Parker and Louise Potter have sent in 2 questions around this. So is there anything we need to be aware of, reference the difference between voluntary redundancy and compulsory redundancy? And Louise has asked, can you explain the redundancy payments we may get? What do you do if NHS rules say, example, 1 week every year? What is the cap? Where does tax start? So I'll quickly just going to put something in context here. Nationally, there is no redundancy that's been agreed with the government and the NHS. So for sure, we don't actually know what we're being offered. What you will have to do is wait for those agreements to be put in place and then find out your individual settlement offers. However, if you want to try and plan plan forward and what you think you may get, the NHS Employers website does have a lot of information on it. And what I'll do is I'll just quickly read an extract from the NHS Employers website, and what I'll do is I'll stick it in the chat once I've finished reading it. So what it says is staff who are made redundant should receive 1 month's pay per year for reckonable service, with a maximum of 24 months pay. So if you've served 24 years, you'll get 24 months pay. In brackets, it says only full years of reckonable service can be counted when calculating redundancy payments, as employment of part of a year should be disregarded. And there is another one about what each one is. I'm not going to sit and read out everything to you, but I will just put that extract in the chat for you to have a look at and have a read. So, oh, sorry, having technical problems here. There we go. So I've just put that in the chat, and that is a direct extract from NHS Employers and what we need to add. James, is there anything you want to add to what I've said there?
Nothing from me, Tim. Thank you.
So the only other thing is, like I said, the difference between VR and compulsory redundancy, we don't have the exact details, as I've already said, but what I will say is, monetary wise, from previous experience that I know, monetary wise, it's not that much different. It's more about the timelines before you can get a job within different organizations. So if you are made voluntary redundant, there is a time cap before you can get a job in the NHS, before you have to pay money back from your redundancy payment. And if it's compulsory, that timeline is just shortened. So that's what I'm aware of for those two, for that to answer those two questions. We'll move on then to the next set of questions. So pension calculations and the difference in the future. So we've had Christopher Ranson and Katie Davison ask similar questions. If you are made redundant or forced to a lower grade job, what would be the impact in your pension, specifically the NHS 95 pension, which is a final salary scheme? If you're in your 50s, can you lock in your present wage and make sure this is used in the final pension calculation scheme and not a lower wage associated with the lower grade? James, is there anything you can answer to that one?
So there is a table that's available online that you can see, which covers the 1995 scheme. I would say with some of these questions that once you get your letter, if like what you're saying is, Tim, some of this stuff's still being negotiated, I guess that can be subject to change. But at the moment, it's the best of the last 3 years pensionable pay is what the 1995 scheme is based on. But what I would say, what I'd say is wait for your specific letter to come out, and then that will then prompt you to engage with the NHS team, pensions team, to be able to ask them further questions. But what it is at the moment would be based on the last 3 years, best of the last 3 years pensionable pay.
So just more for my head, so I understand it. So what if Christopher went to a lower paid job and worked in that lower paid job for over 3 years? That's what his final pension scheme would be based on, not the higher grade that he had, and just the 95 scheme, not the 50.
Yeah, the other one's different. The newer one's a career average.
So your 95 pension would be based on whatever your highest rank is, whatever your highest pay is in the 3 years.
Best in the last 3 years. Yeah, but that's the standard. That's the standard, and there's a table online which states all the ins and outs of the different schemes. But there could be nuances, or they could negotiate something which could affect Chris. That might mean there could be a possibility to do that. So some of these questions, although quite valid and you want to know, they will be made clearer when you get when they get their letters through.
Brilliant. And Katie's asked, if she's made redundant now, leaves the NHS, never to return, she's worked 20 years, what happens to her pension? How can she work out what exactly her NHS pension will be when she retires? And is it affected by things that are going to happen in the future? So how the economy goes, politics, etc.
So everyone's entitled to get a pension statement annually. You can log on via a portal or contact your employer with the NHS, who will be able to support you with accessing it. You can also contact, again, the NHS Business Services team as well, which will be able to support you with getting projections on what you're likely to receive, but it should be within your annual pension statement, which you get normally around October, November time. The good news is, because it is effectively a defined benefit, which is like a final salary, which you've just spoken about, it isn't affected by economy politics per se, because it's a guarantee, effectively a guarantee of income based on your service within the NHS, and it increases based on the pension increase, which is linked to CPI. So every year your pension will increase with CPI. And it won't be linked to things like political factors. Whereas conversely, when we talked about last time around a private pension, so if you put in £1,000, it's worth £1,000. If the markets go up, your pension goes up. The market goes down, your pension goes down. So that is very much linked to economy, politics, what's happening in the globe. With the NHS pension, one of the fantastic benefits of it is you've effectively got that guaranteed income for the rest of your life.
But quickly,
I think you said there's a calculator on. There is a calculator online as well that you can
there
use.
is, yeah. So again, the BSA have a getting your estimate for your pension. There's we're going to put the link in the chat there for you, so that they do have an estimate. My question, James, is, so there's lots of talk in the news about the triple lock and not being able to afford it anymore. Obviously, it's a guaranteed income, and it goes up with the interest rates, basically. If the triple lock was no longer to happen, how would that change how much our pension goes up by every year? Are you able to answer that?
The triple lock was more associated to state pension, isn't it?
That's what I'm talking about. So because it's a
the state pension, yes. I mean, I guess you could argue, which is a good point, to challenge back to me, political factors will have an impact on if they feel NHS is the UK's, the world's largest employer. So if they felt it wasn't affordable, and that's why you've seen the schemes change over the years, because people on the 95 scheme getting a much better pension than you on the 2015 one. So every time they've changed it, they have sort of chipped away at some of the benefits. If you pass away, the dependents benefits are less in the newer schemes than the older ones. Final salary pensions are incredibly expensive for any organisation. One of the benefits of working in the public sector is typically you get access to effectively a final salary or defined benefit pension. So absolutely, if everything become a lot more expensive and the country was a lot poorer, they could decide to make further changes to the NHS pensions. At the moment, they are what they are, and typically, you can imagine with strike action or whatever, this is my opinion, that they wouldn't really touch any other pensions that are already in situ. They may make further changes to the newer pensions with the NHS, but the NHS pension, as far as I'm aware, isn't affected by the triple lock. It's just a state pension. But the state pension with the triple lock, and as you quite rightly pointed out, Tim, it's getting a lot of headlines at the moment. It's very expensive. So a political party could decide to scrap the triple lock in the future on things like state pensions. I mean, the question we always talk to clients about, is it affordable? So the state pension has gone up from like 65 to 67, 68 now. I'm 40. I genuinely believe the chances of me getting a state pension might be slim, or if I get one, I could be in my 70s before I actually receive it. But the state pension is based on national insurance contributions, but you're not actually paying into the state pension for yourself. You're paying in your national insurance contributions for everyone else that's already receiving their state pension. So there absolutely is no guarantee that we will have a state pension, especially younger people, when we get to retirement. Obviously, I hope we do. I don't want this to be doom and gloom and everyone to be worried about the retirement, but it is there's no guarantees with state pensions.
Cheers, mate. We'll move on to the next question then. So losing NHS benefits. Jade Jenkins has asked, the one thing a lot of people I'm speaking to at the moment are struggling with is whether to start applying for looking for other jobs now. But the reality being, any opportunities right now are likely outside of the NHS. So we'll be losing all of the entitlements we have accrued in the NHS before we are actually made redundant. So should people be going out looking for jobs, or should they hold off and try and retain some of the benefits that the NHS has got? James?
Yeah, I mean, for me, you might have an opinion on this as well, Tim. It comes down to personal preference. If the best, a really amazing job comes up and it's prior to getting those redundancies, so there's so many factors on that, isn't it? If you've been working for 20, 30 years within the NHS, that redundancy payment is going to look very attractive. It's going to be quite a large sum. So then to go and look for another job and say, actually, I'll move jobs because this is a great job and I'll forego all of this money is pretty unlikely. Whereas if you've only been working in the NHS for 6 to 12 months or something like that, then it might be more important for you to find a new job that you want to do rather than have the pressure of getting made redundant and then trying to find a job once the income stopped. So I think that question very much, as long as I've interpreted it right, very much comes down to sort of your personal circumstances. And I'm assuming the entitlements is like the benefits with the NHS. So I guess the answer would be trying to find another job within the NHS. But if you can't, there will be, if you go to another employer, you find an employer that you're comfortable with their entitlements and the benefits they have. I don't know if you've got something to add on that, Tim, or if you think I've interpreted it okay.
No, that's exactly how I've interpreted it. And Jade, if you're on the call, if we're getting this wrong, please stick your hand up and we'll be corrected. But in my head, so I'll give you my personal circumstances. I've only been working in the NHS for 3 years, and I started in December. So my third year of benefits of NHS will be in December. So obviously for the ICBs, our organisational change needs to be complete by the end of Q3, which is by the end of December. So it's in my interest personally to take the gamble and not look for jobs and try and get an employment after December. So looking into January, just to get that extra year's NHS pensions benefit. That's me personally. If that wasn't my circumstances, I 100% would be looking for rules right now, because whatever benefits I'm getting from the NHS isn't going to give me money to spend when I'm made redundant in December and I need to pay my mortgage in January. So my personal opinion would be get out, but it's all individual circumstances. You've got to know when your date you started, so your seniority date is. So if there is a date where you cross and you get now that extra year's pension, as I said at the start, you've got to have a full year's pension as part of the redundancy payments. And just so it's all individual circumstances.
And again, anecdotally, from my personal experience, that you might be lucky enough if you work in the NHS for quite a few years, absolutely you probably would want to hold on. But there's nothing wrong with applying for other jobs if you've got time to be able to do that, because if you're a little bit rusty, anything in life, you're better if you practice. So there's nothing wrong with personally, I would say, if looking for other jobs and maybe going for a few interviews. Again, this is personal. If I was in the shoes of being made redundant, because you get the practice, get the bad interviews out of the way. So then when you're ready, when you do need to start looking for a job, you've had that experience of what employers are looking for from an interview perspective, and you've had that practice with it as well, and you can see what's out there as well, rather than waiting, physically getting made redundant and then starting that process of looking what you might want to do. And the reason why Tim has organised this call, even though you haven't had the letters yet, it's all about preparing yourself and giving yourself more choice. That's what life's about, isn't it? Choice. So it's just giving you plenty of time to reflect and think about what you might want to do in the future, rather than leaving things to the last minute or leaving things when the actual clock starts ticking, when the actual redundancy comes in. You've got the choice now to start maybe looking around and see what salaries you want, what jobs you might want to do, and then start preparing yourself for what the interviews will look like. Start preparing what you want your CV to have in it.
Yeah, absolutely, James. Brilliant. We'll move on then. So the next thing, is somebody asking a question there, or are they just not on mute? I'm guessing they're just not on mute. Okay, I'll crack on. So impact to support payments. So Eloise Summerfield has asked the question: I've read that paying off your mortgage, which then reduces your savings, can prevent you from claiming universal credit. Is this true?
To a degree, yes. A lot of the stuff is open to interpretation. The key thing you need to be aware of, and what the benefit system will look at, is deprivation of capital rule. So, for example, if you got your redundancy and paid off a large lump of your mortgage right before claiming universal credit, that could be seen as you've tried to get rid of that money to deprive yourself of that capital, and that could be also things like gifting money to other people, or spending the money on a massive luxury holiday. So that they're actually the examples that are given on HMRC of the risk you could be declined for universal credit. But if it's legitimate, then it's likely you wouldn't be penalised by that. So if you've always intended paying it off, or let's say your mortgage was coming to an end, or the remortgage, and then you could argue interest rates are going up a lot, so you felt like you needed to bring down your outgoings. So legitimate reasons, there shouldn't be an issue, but you just need to be very mindful of the fact that if it doesn't smell particularly great, it probably won't look great from when you're trying to claim the benefit. So if you get your redundancy, pay off a massive chunk of your mortgage and have nothing left, chances are you could get challenged about getting universal credit.
Okay, so is there a better way of doing that then? I don't know. You're probably not able to answer that, are you?
It's a good question to ask, and my point back to you would be, my answer to you would be what I said on one of the slides at the beginning of the last session is reach out to the charities or like Citizens Advice Bureau. So Citizens Advice Bureau have got people that are trained on specifically on benefits. So you could always engage with them, ask them your scenario, and they would have a much more. I don't regularly deal with universal credit or people that go through the process of doing universal credit. So if you engage with someone in the Citizens Advice Bureau, they'll probably have to give you specific examples when it worked and when it didn't. There is thresholds. So if you've got £0 to £6,000 in your bank, you get a certain amount of universal credit, and then figures above that, which you'll get chipped away at. Clearly, I would imagine if I was a person signing off someone's universal credit and they got paid 30 grand and they put all that whole 30 grand paying off their mortgage and had £0 in the bank, I would probably look at that quite negatively. Where if they paid off a proportion of it from a mental well-being perspective, but still had some in savings, which meant they had less universal credit, and it happened just before they were claiming it, then personally I would be a bit more relaxed about it, because it seems like a logical, sensible position to adopt. But it will be. We engage with HMRC on a regular basis on stuff outside of this, and a lot of the time it's up to the individual person that's doing that. So the HMRC investigator, for example, they will have their own interpretation. So you might have one investigator that views it one way and one investigator views it another. So I'd say with this question, it is open to the person that's approving that universal credit at the time. But with stuff like that, I'd always use the smell test. So if it looks okay and what you're doing seems logical, and not doing it to try and deprive yourself of capital in order to get the maximum universal credits, you should be all right.
Brilliant. Cheers, mate. We'll move on. We have a question around private pensions. So Sarah Bayliss, is there a minimum time that you need to have a private pension for? Is it sensible to open one within 5 years of needing to draw from it?
So typically all financial advisors, and the regulation with the Financial Conduct Authority, so they're the people that regulate financial services in the UK, would always say with investments, so investments that fluctuate, so things like stocks and shares, and there's other types of investments that do that as well, that fluctuate, always say a minimum of 5 years. And the reason for that is if you invested the money today and the market's dropped 15-20% the next day, 5 years is deemed plenty of time for the markets to recover and you to get back a good amount of money. So beat cash and actually have a decent sum of money that you're comfortable with. So the whole point of investing in the first place. Anything lower than that, it's always that risk that if you have a big fluctuation in the markets, then yeah, you could be in a situation where it's not quite grown as much as you want. To give you a couple of quick examples, conscious of time, the 2008, the financial crash, the equity market, stocks and shares probably dropped about 15 to 25%, depending on how risky your portfolio was. Within 18 months, it had bounced back. So as long as you didn't need that money in 18 months, it wasn't really too much of an issue. COVID, within 12 months, the markets bounced back. So if you invest in a private pension or any sort of investment, there always are going to be fluctuations. It's just the whole thing of risk and reward. But typically, the longer you can leave something, the lower the risk becomes, because the fluctuations are less relevant. So in answer to your question, technically speaking, absolutely, you could take out a pension today and then come back to the pension provider the next day and say, as long as you hit the requirement of being 55 or 57 years old with a private pension, you could go the next day to the pension provider and take it all back out again if you wanted to. So the pension, the last couple of years of private pensions, ours have done about 12% a year. So after a year, you could come and take all of your money out of your pension, your private pension, if you wanted to. 25% will be tax-free. The rest of it will be taxed as if it was an income. I think we've got a few questions around that later on. But technically, yes, you could use your pension within the 5 years as long as you're age 55 or 57, depending when you want to access it. But typically, a financial advisor would always want to invest your money for 5 years, so we're not so we're managing expectations.
And I think we said it in the first saying, the difference between private pensions and the NHS pensions is private pensions can be really, really flexible. But there is more risk depending on what your risk appetite is, whereas the public, the NHS pensions are absolutely set in concrete, but they are reliable. You will get it for the rest of your life. So there is a bit of a good balance to be had here between investment and private pensions to give it more flexibility for those that want to retire a little bit earlier or want a little bit more income at the start of their retirement, etc., etc. There's a balance to be had between public and private pensions. Excellent. So, Richard, you've got your hand up.
So, sorry, it's only that, you know, really the public pensions are the best overall, aren't they? I mean, I don't think we should have a sort of mixed thing here. You should always have the NHS pension first, and then anything else is a top up on top of it, rather than sort of saying, well, you know, they've both got their pluses and minuses, because most people are very jealous of the NHS pension.
No, Richard, you're absolutely right. And we're not saying it's one or the other. What we're saying is you've got your NHS pension. It's really, really good. It will give you a wage for the rest of your life. But what you can do is to mitigate. If you want to retire slightly early, or retire at your retirement age, and you want a little bit extra money whilst you're still young and sprightly and can sprint around the world, you can use private pensions to subsidise it.
And you can, to subsidise. I mean, I'm absolutely all for subsidising, but again, you know, with the public pension, you can take a bigger or smaller lump sum at the beginning if you want, invest it differently, etc., etc. Sorry, Alan.
Yeah, absolutely agree with that, mate.
I think,
cheers.
I think the key thing is, and it's fine. I always like to be challenged. I think the key thing is, and it's a bit dangerous to generalise everybody. So that's why financial advice is on an individual basis. So we've always said, and I would always say to clients, final salary pensions are great. NHS, I don't think you can deny, Richard, they're less attractive than what they was. The 95 scheme is fantastic, and the 2015 is less attractive than the 95 scheme, right? But the key thing is, and I always go back to, life's all about choices. And as Tim's quite rightly pointed out, some people absolutely like the fact of having a mixture of the two. Why do people transfer out final salary pensions? I don't want to go off tangent too much. You can't do that for an NHS, but I'm just making the point, Richard, that there's lots of people that do transfer out final salary pensions because they like the flexibility, and also they like the fact that they can leave a legacy to their children. So there are reasons to and from, and all we're doing is pointing this stuff out and then making people more informed. I think it's important to educate people so they understand the choices, and then they can make their choice based on their own personal circumstances.
How about that, Richard? Excellent, mate.
Yeah.
And no, you're absolutely right. And thanks for bringing it up. So we'll move on. We'll quickly move on. So talking about investments. So Kiz, my friend Kiz, she's asked, do we need to consider the percentage costs of fund management? Would save 8k and would be costs of managing SIPs, etc.
Yeah, I didn't quite understand the 8k bit, but you need to consider the costs. Yeah, I mean, ultimately everything in life you want value for your money, right? So yes, you need to consider the costs of fund management. Typically, it comes in at about 1 or 2% per year. But the key thing I would always say to clients is the value for money piece, and performance is actually quite important. Is clearly important, because if an investment you choose to invest into achieves 5% per year and it's a 1% charge, obviously net you're going to get 4%. But if there's another investment that's actually better managed and it's a 2% charge, but it makes 10%, so you're looking at an 8% net return. So you just need to be a bit careful and mindful if you feel like you're getting value for money.
I don't think I've seen Kiz on the thing. Kiz, are you there? No. She mustn't.
The only thing the other thing I can think of is if you're talking about every provider has different bandings, different charging structures. So some do it on a percentage and have like a standing charge, like a fixed monthly amount. So every provider is slightly different on that. And if you've got a small pot of money, there will probably be a provider that will charge you mainly on a percentage. Because if you go to a provider that charges a flat fee of like £25–50 a month to have the platform of the investment, if you invest in something like 8K, that represents quite a large percentage. Whereas obviously if you're investing £100,000 and your platform charges like £50 a month, it's not as much. So the different providers will offer different charges.
Cheers, mate. Yeah, without Kiz being on the call, I don't think we can understand the 8K, but
hopefully did all right.
That answer the question. Right, we'll move on to the next question then. So this is about redundancy implications. So Melissa Goodland, if you have a second source of income, i.e. locum work, would that affect redundancy terms, or would it be more risk of redundancy? If I've received a redundancy payment, could I still work as a locum for other companies straight after receiving the payment? James, I don't think this is one you're going to be able to answer because this is very NHS terms and conditions, isn't it? So what I will say is, if you go to the NHS employers website that I've put in previously, there is a section in there that's around redundancies and concurrent activity. And what it does is it gives you loads of scenarios of concurrent working through the redundancy period. But that's too difficult for us to ask because we don't have the redundancy agreements. We don't know what the terms and conditions are, but there are examples of previous. So I've just put the link back in the chat there for redundancy repayments. Once you get onto that link, you'll scroll through. There's frequency asked questions in different sections. And one of the sections is redundancy and concurrent activity. There are a number of scenarios in there, Melissa, and hopefully one of them scenarios will be relevant to you in your situation. So I apologize, we're not able to answer that in detail, but we can show you the best place to go and have a look. Does that, Melissa? I think I've seen Melissa on the call. Hopefully that's helped you.
Yeah, it has. Thank you. Yeah, it's because I just wasn't sure. I'm a pharmacist, so a lot of pharmacists do locum work alongside NHS work, and I just wondered, if I was doing locum work, would that put me more at risk of redundancy because I've got kind of another job as such, even though it would have been in place anyway. But again, like you say, but you can't. It's a specific circumstance, so I know it's difficult. But thank you anyway.
But the only thing I'd add to that, and this is my personal opinion, don't take this as gospel, it shouldn't have having a second job shouldn't have any effect on the way that you are, if you're made redundant, because it's about the role, not the person. That's my understanding of it. Somebody that's more intelligent than me, please jump in and tell me off if I'm saying the wrong thing, but that's my opinion of it.
Thank you. Cheers,
Melissa. Okay, so we'll quickly move on then. We have a lot of questions around tax. I'll start that sentence again. Tax implications with the redundancy payments, and some of these are very similar. So I'll just go through one by one And if it's repeated information, James, as I say, I've already covered it, but we'll try and get through because there are a lot of them. So, Julie Parker, so potentially receive the redundancy payment in Q3. Salary up to that year plus redundancy will be income, so may quite possibly taxed at a higher rate. Is there anything we can do to offset this?
Yeah, so you can contact the NHS pensions team to see how much you could pay additionally into your NHS pension. So that will then reduce the tax liability you have. Or you can obviously pay into a private pension if you wanted to. That would also reduce your tax liability, and also any other salary sacrifice arrangements. So anything like cycle to work scheme, car leasing, childcare. Now that might not be relevant clearly if you're getting made redundant from the NHS, but if you do start a new employment and then you continue to receive income and you want to try and reduce your income as much as possible, anything that involves some sort of salary sacrifice arrangement, that will reduce your income and then mean you're not going to be taxed at the higher rate.
Cool. And what I will say as well is salary sacrifice doesn't only bring down your wage from a tax perspective, it also helps your employer because he has to pay less national insurance tax once you do that. So obviously there's been a lot of talk about national insurance being raised for employers, so especially small employers. If they do salary sacrifice schemes and you use them, it can contribute to lowering their national insurance tax burden as well, which is always a bonus.
And I was just to finish off, just bear in mind the redundancy. I think we've mentioned it a few times. You've got the 30k, £30,000, which is tax free. Anything above that is added to your income. So, as a very quick example, if you earn 35,000 with your job, and you get £20,000 redundancy, then none of it would be subject to additional tax.
Cheers, mate.
The redundancy payment.
Yeah. Lisa Wilkins, if you take early retirement and use redundancy to increase your pension entitlements, how does that affect your tax liability? You've kind of already covered that. It will lower it. Anything to add?
And then I wasn't 100% sure whether there's some of the point on that. I don't know if it was on the way out as well. So on the way out with the NHS pension, you'd have the 25% tax-free lump sum if you wanted to take that. Anything outside of that tax-free lump sum is taxed as if it was an income.
Okay.
So on the way in, tax efficient, tax free, you're not going to pay any tax on it going in. On the way out, 25% you'll get as a tax free lump sum, and then the rest as if it was an income.
Yeah. Okay. So we've got the next couple of questions. So Caroline Smith and Heidi Taylor are both asked about national insurance contributions. Is national insurance charged on any redundancy payments? And do you have to keep your national insurance contributions? Do you have to keep them topped up so you don't have a gap?
So typically you need around 35 qualifying years. Doesn't need to be consecutive. You need 35 qualifying years of national insurance, and that actually might not mean you've even paid national insurance, but you tick the box to say it's a qualifying year. So if you're a low earner for a few of those years, but it ticks the box as a qualifying year. What I would say to you, and a lot of these questions are all sort of individually based, is you can go online on HMRC and fill in a form, so you can see online what you're likely to get in retirement for state pension, and if there is any gaps, you can typically top it up. And I get this question a few times from clients: is it worth it? Richard will love this. So typically yes, because it's a guaranteed income for the rest of your life. So rather than not top it up and not put monies into it to top up your your national insurance contributions, it's typically worth topping it up. On average, it takes about 3 years to get your money back, and hopefully most people, when they get to state retirement age, will live more than 3 years. So typically with clients, if there's ever a gap with that, I would normally say it's probably worth topping up. Obviously, I can't guarantee how long someone's going to live, but generally speaking, people survive more than 3 years once they get their state retirement age. Do you want me to just go on to the next one? And then, is national insurance charged on any redundancy payments? So typically no. There is I'll probably stop it there in the interest of time. So typically no, there won't be national insurance charged on redundancy payments.
Cheers, mate. James Neal's asked, despite the 30k being tax-free, is it still classed as an income when being assessed for other things like student finance?
You'd be pleased to know for student loans, no. It's not classified, although from a tax perspective, as we've already said, the 30k tax free, but anything above that is taxed as if it was an income. When they're doing the calculations for student loans deductions, redundancy payments are explicitly excluded from this definition.
Excellent. Kathy Bailey, if your current earnings are just under 40% tax threshold and is going to be the receipt of your state pension, is it advisable to defer your state pension if you are potentially going to be put at risk?
It's an interesting one. This is very much down to the individual. I'll mention a couple of things. You can defer your state pension, and typically as a result of that, you'll get an extra 5% per year. But there's some interesting ways you can try and minimise that, because if you defer in your state pension, you're obviously not taking that money, so that 11-12 grand, you're not actually receiving that money. So yes, you're getting an extra 5%, but if anything happens to you, you pass away, you've not actually had that money to enjoy it. If you did decide to, so I've got some clients that are still working, that still take their state retirement when they can receive it. And if you're earning, you can put money into a pension, whether that be the NHS pension and top it up, or whether you do a private pension, and that will then bring your salary down, as we were talking about the salary sacrifice piece. So if you wanted to, you could take your state pension and take that 11k or whatever you're going to be receiving, and then you could put the equivalent of your earned income into a pension, and therefore not breach the £50,000 and pay 40% tax on it. So still benefiting from all that money, but you've just put it in your state, put it into another pension, so you can use it at a later stage, but not suffering 40% tax.
Right. Okay.
Is that clear, Tim?
I think, yeah.
What were you hesitating?
I was hesitating. If you defer your state pension, which I didn't even know you can do, yeah, it's not like you're going to be putting that money somewhere else. It's not going to be saved, is it? Because it's just in the. So if you defer it for the first year, that 10 grand, 12 grand, whatever you're going to get, isn't going to go back into the pot. You're just going to lose it. So
yeah,
I don't understand why you would ever defer your state pension, take it, put it somewhere else. You're going to get taxed on it, but that tax is going back into the pot, and you're going to get some money that you can invest somewhere else. I just don't see the point of it, if that makes sense.
Yeah, I mean, you do get an extra 5%, around the 5% mark added on for every year you do. Every year you defer it. So some people do choose to do that, but typically the clients that we deal with, if they qualify for their state retirement and they're still working, yeah, we would typically say take it, like you said, Tim. So it's your money, it's in your estate. So if you do pass away, you can give it to your beneficiaries, or you use it and enjoy it and potentially pay 40% tax. But being a bit savvy, then what you could do is put some of your earned income, the equivalent of, into a pension, again, whether that's the NHS one if you can, or a private pension, to bring your earnings below the 50k mark. So you're almost getting the best of both worlds. You're keeping your pension, you're getting the state pension, but not paying any tax.
Yeah, makes sense. Okay, we'll move on. Louise Potter, are there any tax implications if we receive a lump sum in a redundancy payout? And are there any ways of reducing tax by saving or investing elsewhere? We have already covered this. Is there anything you want to add?
No. So I very briefly will say though. So you've got the 30k tax free. The rest of it's taxed. And then the ways you can get around that is anything to do with salary sacrifice, really.
Cool. We've got an anonymous question. If up to my leaving date I earn, including redundancy payments of up to £50,000, do I pay 20% basic tax on the redundancy payment on anything above 30k tax-free amount?
So I read that as yes. So if the redundancy payment, excluding the £30,000, takes you to £50,000 and some change, then yes, you're paid 20%. If you get more than that, if you're excluding the 30k, if you're getting more than 50,270, including the bit above the 30k and whatever you've earned in the tax year, then you'd pay 40% above that.
Yeah, that makes sense.
There is some additional taxes, just to be very granular. There is some additional taxes if you breach 100k and 125, but there'll be very limited people that I would have thought would be affected by that. But if you do, then again, you can speak to a financial advisor or maybe Google it.
Okay, the next one is a very similar question. Is there a tax-free standard personal allowance of 12,507 in addition to a 30,000 tax-free redundancy allowance? If so, does this minus off your earnings, hopefully keeping me in the 20% bracket?
Yeah. So if you earn 35k, out of that 35,000, 12,570 will be taxed at nil, and then anything above that will be taxed at 20%. So the 22,430, that will be taxed at 20%. So your nil rate band is still, it's all included, but out of that figure, it'll be taxed at zero. So 12,570 will be taxed at zero.
Perfect. So Leslie Croston's ask, could you please ask the question around the point of the financial effects tax on redundancy? I have heard from colleagues that the redundancy payment is received towards the end of the financial year when tax allowance have been used already through salary earnings, and therefore I'm wondering if redundancy payments could then tip into the highest tax band of all. We are hearing that compulsory redundancy may occur until the end of March, so this could be detrimental to relation to tax.
Yeah, so I think this comes down to a bit about personal circumstances as well. But if it happens earlier in the tax year, so after April the 6th, rather than right at the end when it sounds like it potentially could happen around March time, the only difference really is it gives you more options to do something about it. Because obviously, of course, if it happens at the beginning of the tax year, so let's say you get made redundant in April, May time, and those people still need to work, your earnings are then going to be added anyway, so you might breach the 40% mark because you still need to earn an income, but you would have more time to decide what you want to do with it. So you have the redundancy payment, and then you can choose whether to try and bring down your salary, whether you pay that into a pension or something else. Whereas if it happens at the end of the year, then yeah, you might be a bit tight to get it in before the 5th of April. But I think for that, it doesn't really make much difference, right? So you either get your redundancy payments at the beginning of the year, and then you carry on working, and then you're going to breach it that way, or you're going to work, get a new job, and use your allowances, and then you get your redundancy payments in March, which is going to take you over anyway. So it's sort of the outcome's pretty much the same, apart from the time you've got to make any changes to it.
Okay. So I will say that we're being told that by the end of Q3, which is the end of December, is when it all has to be complete. So it would, to me, I'm saying that it would be at the end of the year. So it might be once you've got your offer, you need to make some quick decisions around what, with your redundancy payment and what you're going to do with it. It's going to be a quick turnaround. I will say we are running a webinar around effective tax planning. It's around for really high earners, so it's about making sure you don't go into high tax band, etc., etc. It's not about redundancy payments, it's just effective tax planning, and that's being provided by Affinity Connect, and I'll stick the link to that in the chat. It's the link to go onto that webinar. So yeah, that might be of some use to you prior to getting your redundancy payment, because they do a lot around efficient tax planning. So I'll stick that in the chat now. So yeah, if you're interested, click on that link and you can book on the tax planning webinar. And I've just seen in the chat there, Nikki, as I was putting it in, the tax planning webinar we can't record because Affinity Connect legally won't let us do it. So they won't be able to share the slides. You've got to attend, unfortunately. So I apologise. So that's everything from it when it comes to a tax perspective. We're now going to move on to the kind of final question. We've got 10 minutes. Using redundancy payments to build up your pension to retire. Now, we have got a lot of questions about this, and we've got people quoting in their question, putting quotes in from some documentation and stuff. So James, we talked about this yesterday. You have requested some advice from your technical team, haven't you?
Yes, yeah. There's a couple of bits we can cover off if you want. It's up to you.
Well, we've got 10 minutes, so we can either what I was going to say is what James is going to do. James is going to get some advice from his technical team just to collate some information. And then I think what we agreed, James, was that you're going to do something on the 2nd of July when we repeat this, aren't you?
Yeah.
So hopefully we can present some information on the 2nd of July, which will cover off most of the questions that you guys have put in, because there is a lot of them really interested in this. Instead of me going through all the questions, if there's some you can cover off now, James, do you just want to go through what you can cover off, and the rest we can leave until the 2nd of July, if that's agreeable?
Yeah, rather than just hearing my voice, do you want to Sean Macy's? We can pretty much cover off.
Sean Macy's. Okay. What is the maximum amount of redundancy payments that you can put into the NHS 2015 scheme to minimise your tax losses in a financial year when we are made redundant to take VR? Is this a good way of minimising your tax losses?
So yeah, the easy answer, I guess, is yes, because as we've spoken about throughout this whole session, by paying extra money into your pension, you reduce your income tax liability. So whether you see it as tax losses or paying tax, yeah, by paying into your pension, it is a good way to minimise the tax liability you'd have. Again, online there is a few things available. It does say the maximum additional annual contribution that you can pay into your 2015 scheme is to get an extra £6,500 per annum in today's terms. A lot of these questions, but I'll cover them off in more detail in the next session, but a lot of these will be everyone's individual circumstances, so you'll need to contact the pensions team, and they'll be able to help you with how much you can put in, or how much you can put in extra and what effect that will have on it. They don't give advice, but they can give you the facts so you can make an informed decision. Hopefully that helps, Tim. And then Victoria Bolter, I think we can cover that one as well.
Yeah. So can you take the 1995 section at age 50? What would be the penalty cost reduction for taking it 10 years early? I presume you can't buy years in this pension as it's frozen and we were made to transfer to the 2015 scheme.
Yeah, so this is a similar one where you speak to the pensions team as well to get your own specific one, but there is information available online. So yes, you could take your pension at 50 as long as you're an active member between March 2000 and the 5th of April 2006, but you would get early retirement factors that would apply if you're taking your pension prior to the age of 60, which effectively means a reduction in the income that you would receive. Those are available online. So if you took your pension at 50, the pension would reduce by about 33% and the lump sum figure would reduce by about 21%. But what I would say with this sort of stuff is always contact the team to make sure and clarify your own personal circumstances with them, because they can give you specific figures based on your circumstances. I mean, what I've found is with dealing with clients that we've got that work for the NHS and going through this process as well, there's a lot of complexities. I'm a qualified financial advisor, and there is a lot there. So that team will give you specific information based on your circumstances.
Thank you. That's
no
great.
worries at all.
Go on, Richard, you can jump in.
Yeah, I believe also that if you are taking early retirement on grounds of redundancy, then you can use your redundancy payment to buy out that reduction in pension. So that's another way of going about it. But again, that's something you'd have to talk to the pensions agency about.
That's a really good point, Richard. Yeah, that's one of the questions we've got for later on, which I was going to cover off in a bit more detail at the next session. I think Nicola asked that. But so thanks for doing that. I would say there's another question around if there is any redundancy lump sum left, would 30k still be tax free? So the 30 it's looked as a collective in a total. So you've got £30,000 of tax free, but anything above that would be taxable. So if you then put into your NHS pension or anything else, and that reduced it to below that 30k, the rest of that figure would be tax free. And I think, Tim, that's probably the most we can go through today, just without otherwise I'll be too vague and it's probably not going to add much value to actually, sorry. Can I and can you do Louise Potter's one? And then that's it.
Louise Potter. I currently pay into my NHS pensions and AVC. Is it better to pay more into my NHS pension or increase payments to my AVC.
Yeah. So it depends on what you see as a priority. And as Richard, Tim, and I have pointed out, the huge benefits with an NHS pension is you've got a guaranteed income for the rest of your life. So people that like that security to knowing that they've got a certain amount per month for the rest of their lives, it's fantastic because your pot's never going to effectively run out. Whereas if you've got a private pension, it's worth £100,000 and you spend £100,000 in 5 years, it's gone. You don't have it anymore. So it does depend on your individual circumstances and what you see as a priority. As we've already said, that some people see if you've got a pot of money in a private pension, they quite like the fact that they can dip into it and there's a lot of flexibility around how they use it. So they can use a lot more in the early years and then they don't spend as much in the later years. And then lastly, there's some people quite like private pension on the basis that passing it on to beneficiaries. So with final salary schemes or defined benefit schemes, which is what the NHS is, and there's many other schemes out there with older pensions. If you pass away, there'll be some sort of benefit that will go to a spouse or dependent, but that's typically less than what you would receive as an individual. So some people don't like the fact that if they pass away, then a limited amount will go to a surviving spouse or dependent. Whereas with like a private pension, if it's worth £100,000, you put £100,000 in, you put a pot of money in there, and it's worth £100,000. If you were to retire and pass away the next day, that £100,000 will be given to your spouse. At the moment, before the age of 75, will be tax-free outside of your inheritance tax. The rules are potentially going to change in 2027, but it's under consultation at the moment.
Brilliant.
Anything you want to add, Tim? Other than that, I think I'm done.
We've got 2 minutes left. I've just scanning through the chat and people have been putting stuff in the chat as well. So thank you very much for helping us to spread the information as much as you want. It's not just about me and James. We all get together and we can support each other. There's a few questions in there about recording which have been answered. Yes, it's recorded and it will be on our financial wellbeing webpage. Greta's asked if there's a possibility to have personal one-to-ones with you, James. If you're in South Yorkshire, in the South Yorkshire ICS, so either Barnsley, Rotherham, Doncaster and Barnsley, yes, you can. You can either do it through the Minto Wellbeing platform. You have to register for that, and we've put links in previously. If you are wanting to get those links, please email the generic email box. Sarah, can you just put the generic email box email address in the chat there? So if anybody wants to get hold of us and register for things like that, please go there. But I can see, Greta, you're from NHS Humber in North Yorkshire, so that scheme isn't open to you. So James, without putting you on the spot, what is your availability to help others that are outside of South Yorkshire doing one-to-one planning?
Yeah, so we did. I think we spoke about this last time. If you want to put it in the chat or put it online, then yeah, happy to. I think we posted my details last time in the chat, didn't we?
Yeah, we did. Yeah. So Greta, what we'll do is if James, do you just want to stick your email address and go direct, or do you want it to come through us?
You can go direct. Like otherwise, someone in my team will pick it up as well. So it's.
Do you want to stick your email address in the chat then?
Yeah.
Tim, that's really helpful. I really appreciate it. Thank you, because I did post questions, but I realised they were quite niche given the circumstances.
Yeah, no problem, Greta. So right, we all just ran out of time. Thanks everybody for attending. As I said, it will be the recording will be up on the financial wellbeing page, and the links are already in the chat. And as ever, we're always after evaluation. So I'm going to stick a link in the chat now to our evaluation form. If you could just take 2 minutes to fill that out, that would be great. So thank you very much, James. Hopefully we've helped as many people as we can. For those of you that haven't had your questions answered or talking about buying pension stuff, the 2nd of July is the next one we've got. Please book on for that to get those questions answered. So apart from that, I'll let you go. We're 1 minute over. Have a nice day.
Thank you both. Everyone. Really good.
All right. Bye.
Sarah, can you stop recording, por favor?